We're talking about restaurant brands. That's right. So symbol QSR. It trades on the TSX, also trades on the New York Stock Exchange in US dollars. But I'm going to just cover the TSX Canadian Exchange stats here. So in Canadian dollars, trades at $90 per share. It's a 28 billion market cap company. It also pays a nice yield of 3.3%. So of course, this is a company that we follow fairly closely in our Canadian income research. In fact, when we did our 2023 Canadian Dividend All-Star Report, Restaurant Brands was one of the companies in the top tier monitor list. So we're quite familiar with them. They are a global quick service restaurant company, so fast food. They own 4 fast food brands, including Tim Hortons, Burger King, Popeyes, Louisiana Chicken, and Firehouse Subs, which is the most recent addition. But they are a huge company in the quick service space, one of the biggest in the world. Over 28,000 restaurants in 100 countries. So I just kind of realized as I was putting these slides together that last week I covered the largest restaurant company in the world, which is McDonald's. Now I'm covering one of the I would imagine probably top 5. But anyways, let's take a look at recent performance of this company. So over the past 5 years, stock hasn't really gone anywhere. Quite a bit of volatility, of course. More recently, over the last 12 months, there's been a lot of volatility as well. A little bit of share price return over the last 12 months, but it's taken a bit of a dive since the summer. And this is typical with a lot of stocks. There's just been quite a bit of volatility since this time. But as I said, Q3 results were just released. So we're going to take a look at those as well as a few other items with QSR and just see what type of investment it looks like over the long term and in the near term. So looking at the Q3 results, as the top line numbers, total consolidated revenue was 1.8 billion. That was an increase of 6.4%. Adjusted EBITDA up 8.7% to 698 million. These are all US dollars. And earnings per share of about 90 cents. And that was actually down 6.3%. So the first thing that you want to look at is you saw higher revenue, you saw higher adjusted EBITDA. Why are we seeing lower earnings per share? Well, a couple reasons for that. Higher tax expense, moderately higher interest expense. Not a huge jump in that number, but still enough that it impacted the very bottom line and soaked up a lot of that adjusted EBITDA. So really, when you're looking at a company like QSR, you have to do this brand by brand. And as I said, Burger King, Tim Hortons, Popeyes, Firehouse Subs, these are the main brands. So looking at the number of restaurants in the pool here, Burger King is definitely a top spot, 19,000 restaurants, and they've increased that number by 2.4% over the last year. Tim Hortons, 5,700 restaurants, up 5.5%. Popeyes, up 11% to 4,300 restaurants. And then the most recent addition, Firehouse Subs, that's the little guy in the portfolio, and that's 1,266 restaurants, up 2.6% year over year. And then in terms of revenue, again, Burger King significantly dominating the others, more than 50% of total revenue. In fact, close to 70% of total revenue. So, when you look at this company as a diversified restaurant business, you really have to consider that concentration into Burger King. But their revenues quarterly were up 10%. Tim Hortons revenues up almost 10%. Popeyes had the biggest boost of 6.1%. And then Firehouse Subs, which is really a small portion of total revenues, was up 7%. Now, all 4 of the brands produced comparable same-store sales growth. Burger King increasing their comparable sales 7.2%. Tim Hortons increasing at 6.8%, Popeyes up 7%, and then Firehouse Subs up 3.4%. So looking at some of the outlook points here. So management expects that they're going to enter 2024 with momentum driven by strong performance of its brands. So continued same-store sales growth, continued expansion of the network of restaurants as well. Now, they did note some near-term challenges. That includes inflation, foreign exchange volatility, as well as rising interest rates. So these are factors that obviously impact most industries right now. Certainly the inflation, the rising interest rates. in a situation like QSR being a very capital intensive business, I would say that it affects them more than most, particularly the wage inflation, because obviously it's a very labor intensive business. But just also just general inflation across the board. They also have debt on the balance sheet, so rising interest rates have a negative impact. The company plans to continue to invest in growth and reduce their net debt leverage as well as return capital to shareholders. So 360 million was returned to shareholders in Q3, but they have about $1 billion share repurchase program, which is in place until September 2025. Now, taking a look at that balance sheet, we want to make sure that a company is on a firm financial foundation. So they have net debt of about $13 billion, equity, shareholders' equity of $4.7 billion. So net debt to EBITDA, that's 4.8 times. Pretty high multiple. Now, restaurant businesses tend to have higher net debt to EBITDA leverage ratios. I would say that, QSR's ratio is certainly well at pushing beyond the top boundary of what we would want to see in terms of a leverage ratio. I will say, however, it is down year over year. So it was 5.2% last year, or 5.2 times last year, rather. So they are trying to push it down, and they've been successful. Debt to equity 3 times, fairly high multiple. And then looking at future growth. So just taking a look at some of the analyst estimates. Analysts are expecting at the midpoint of consensus about 3% earnings per share growth this year, increasing to about 7% next year. So 7% growth next year. And right now, the stock is trading in about that 20 times earnings range. So if we look at QSR's 8-year average, it's about 26 times. Certainly, it is below the average, but you can't just, that's not an apples to apples comparison. Growth really isn't that high right now, low to mid single digits. So as well, valuations across the market have been compressed over the last several years, and that has to be factored in as well. And just looking at the company's historic financial performance, revenue growth, it's been fairly consistent with 1 year of decline, which was 2020. So we would expect that. But the revenue growth has been fairly consistent going back over the history of QSR, which goes back to 2015. Earnings per share growth, not nearly as consistent. We've seen a fair bit of fluctuation. Obviously, 2020 was a very bad year for the restaurant industry, for a lot of the restaurant industry anyways. But even outside of that, we've seen some years of fluctuation. So our take, we love the brands. I mean, it has 4 unparalleled brands, so it's a diversified global company. We like the quick service restaurant space. If you're going to invest in a restaurant company, we're not very attracted to like the mid-range restaurants, sit-down restaurants, but quick service tends to be a little more defensive in a recessionary environment. It is trading at a valuation below its long-term average. It's expanding its restaurant network, their same-store sales growth, and they're also reducing leverage and returning capital to shareholders. However, on the other side, earnings growth has been fairly inconsistent. And in the near term, earnings growth is actually quite meek. I mean, only about 3% growth expected this year. We saw a decline in earnings per share in the last quarter. Certainly, 7%, 6 to 7% next year is more impressive, but they still have to hit that. So when you're looking at the earnings growth, the 20 times PE multiple, the valuation is not especially attractive relative to the growth rate. And then, of course, they're also exposed to inflationary pressures as much or more than most other industries. So we like the company long term. We think it's a very solid business. As a stock, I would say that it's probably fairly valued in the near term, maybe a long-term opportunity, but on a growth to valuation perspective right now, I'd say it's trading, close to where it should be.